Welcome to our introduction on understanding mutual funds. Mutual funds are a popular investment choice for both seasoned investors and beginners. They offer a way to pool your money with other investors, allowing you to invest in a diversified portfolio of assets. A professional fund manager manages these assets. Think of a mutual fund as a basket of stocks, bonds, or other securities. When you invest in a mutual fund, you buy shares of this basket. Your investment represents a portion of the fund's holdings. Mutual funds provide a convenient and accessible way to participate in the financial markets. Imagine you want to invest in the stock market, but lack the time or expertise to research individual stocks. Mutual funds offer a solution. They provide instant diversification and professional management. This is especially beneficial for those new to investing. Mutual funds are offered by investment companies. These companies manage a variety of funds with different investment objectives. This allows investors to choose funds that align with their financial goals. Whether you aim for long-term growth or regular income, there's likely a mutual fund that suits your needs. Now, let's explore the benefits of investing in mutual funds. Mutual funds offer several compelling benefits. These advantages make them an attractive investment option for individuals. One key benefit is diversification. Mutual funds invest in a wide range of assets. This spreads the risk and reduces the impact of a single investment performing poorly. Another significant advantage is professional management. Mutual funds are managed by experienced portfolio managers. These professionals have the expertise to research, select, and monitor investments. They make informed decisions to achieve the fund's investment objectives. This relieves individual investors from the burden of constant market monitoring. Affordability is another appealing feature of mutual funds. They allow investors to access a diversified portfolio with a relatively small investment. This is because the cost of buying a basket of assets is spread among multiple investors. Mutual funds democratize investing by making it accessible to individuals with varying budgets. Mutual funds also offer liquidity. This means you can easily buy or sell shares of the fund. The price at which you buy or sell is determined by the fund's net asset value, or NAV, which is calculated daily based on the current market value of the fund's holdings. This liquidity provides flexibility to investors who may need to access their funds. Let's dive into the types of mutual funds. Mutual funds come in a wide variety. This caters to different investment goals and risk tolerances. Equity funds are one major category. These funds primarily invest in stocks. They aim for capital appreciation, meaning they seek to increase the value of your investment over time. Bond funds, on the other hand, focus on investing in bonds. Bonds are debt securities issued by governments or corporations. They typically offer regular interest payments and have a lower risk profile compared to stocks. Bond funds are suitable for investors seeking steady income. Index funds track a specific market index, such as the S&P 500. They aim to replicate the performance of the chosen index by holding the same securities in the same proportions. Index funds are known for their low fees and passive investment approach. They offer broad market exposure without the need for active stock picking. Sector funds specialize in a particular industry or sector, such as technology, healthcare, or energy. These funds allow investors to concentrate their investments in areas they believe have high growth potential. However, sector funds can be more volatile than broader market funds due to their concentrated focus. Finally, we must address the risks and concerns associated with mutual funds. While mutual funds offer numerous advantages, it's crucial to acknowledge potential risks and concerns. One common concern is market volatility. The value of mutual fund investments can fluctuate based on market conditions. This inherent volatility can lead to losses, especially in the short term. Another risk factor is fund manager performance. The success of a mutual fund heavily relies on the expertise and decisions of the portfolio manager. A skilled manager can generate positive returns, while an underperforming manager can negatively impact the fund's value. It's essential to research and evaluate the track record of fund managers. Fees are another important consideration. Mutual funds charge fees for managing your investments. These fees can vary depending on the type of fund and the investment company. It's vital to understand the fee structure of a mutual fund before investing. High fees can eat into your returns over time. Diversification is a key risk management strategy when investing in mutual funds. By spreading your investments across different asset classes, you reduce the impact of any single investment performing poorly. Diversification helps mitigate risk and enhance the potential for long-term returns. Choosing the right mutual fund requires careful consideration of your financial goals, risk tolerance, and investment horizon. Start by defining your investment objectives. Are you seeking growth, income, or a combination of both? Your goals will guide your fund selection. Next, assess your risk tolerance. How comfortable are you with market fluctuations? If you're risk-averse, consider bond funds or balanced funds that combine stocks and bonds. If you're comfortable with higher risk, equity funds might be more suitable. Your investment horizon is another crucial factor. How long do you plan to invest your money? If you have a long-term horizon, you can tolerate more risk and aim for growth-oriented funds. For shorter-term goals, consider lower-risk options. Research potential mutual funds thoroughly. Pay attention to their investment strategy, past performance, fees, and the experience of the fund manager. Compare different funds and select those that align with your investment criteria. Section 6. Diversification and Risk Management. Diversification is a cornerstone of sound investment strategy. It involves spreading your investments across different asset classes, sectors, and geographic regions. This approach helps reduce the impact of any single investment performing poorly. Imagine you invest all your money in a single stock. If that stock declines in value, your entire investment suffers. However, if you diversify by investing in a mix of stocks, bonds, and real estate, the negative impact of a single investment is minimized. Mutual funds offer built-in diversification. They invest in a variety of assets, providing instant diversification to investors. However, it's still essential to diversify across different types of mutual funds. Don't put all your eggs in one basket, even if that basket is a diversified mutual fund. Consider a mix of equity funds, bond funds, and index funds. This creates a balanced portfolio that can weather market fluctuations. Additionally, consider diversifying geographically by investing in international funds. This provides exposure to global markets and reduces reliance on any single country's economy. Section 7. Evaluating mutual fund performance. Evaluating the performance of a mutual fund requires a nuanced approach. Past performance is not necessarily indicative of future results. However, it can provide insights into the fund's historical track record and the manager's investment style. Look at the fund's long-term performance over different market cycles. Consider its performance relative to its benchmark index. A benchmark index serves as a reference point to assess the fund's performance. For example, an S&P 500 index fund should ideally perform close to the S&P 500 index. Pay attention to the fund's risk-adjusted returns. This metric considers both the returns generated and the level of risk taken to achieve those returns. Higher risk-adjusted returns indicate better performance for a given level of risk. Consistency of performance is also crucial. Look for funds that have consistently outperformed their benchmark over time. Avoid funds with erratic performance swings, as they may indicate inconsistent investment strategies or excessive risk-taking. Section 8. Investing in mutual funds. A step-by-step guide. Investing in mutual funds is a relatively straightforward process. Start by identifying a reputable investment company that offers a variety of funds. Research their funds, fees, and investment philosophy. Once you've chosen a fund, you can typically invest through the investment company's website or through a brokerage account. You'll need to provide personal information, choose an account type, and select the amount you wish to invest. Mutual funds can be purchased in two ways, through a lump sum investment or through a systematic investment plan, or SIP. A lump sum investment involves investing a large amount of money at once. An SIP involves investing a fixed amount regularly, such as monthly or quarterly. After investing, you'll receive account statements that track your investment's performance. You can also monitor your investments online or through mobile apps provided by the investment company. Remember to review your investments periodically and make adjustments as needed. Your financial goals, risk tolerance, and market conditions may change over time. Rebalancing your portfolio helps ensure it aligns with your current investment strategy. Section 9. Conclusion: Mutual funds and your investment journey. Mutual funds offer a versatile and accessible way to participate in the financial markets. They provide diversification, professional management, affordability, and liquidity. By understanding the different types of mutual funds, addressing potential risks, and following a disciplined investment approach, you can leverage mutual funds to achieve your financial goals. Remember that investing in mutual funds involves inherent risks. Market volatility can impact the value of your investments. It's crucial to diversify your portfolio, research thoroughly, and seek professional advice if needed. Mutual funds are a valuable tool for both seasoned investors and beginners. They can play a significant role in your long-term investment journey. By making informed decisions, staying disciplined, and continuously learning about the financial markets, you can navigate the world of mutual funds and work towards achieving your financial aspirations. Remember, the information provided in this essay is for general knowledge and informational purposes only. It should not be considered investment advice. Conduct thorough research, consult with a qualified financial advisor, and carefully consider your individual circumstances before making any investment decisions.